Hello investors, I'm Stuart Cruz and welcome to Cruz Asset Management's Market Updates. In 2021, we're going to take a different approach as opposed to making a video chart every day on some sort of semi-random topic. We're going to give you a bigger overview so maybe these videos have some more cohesiveness and some more meaning. So what better day to start than the day after Inauguration Day? We have a new president in place. And whether your man won or lost, let's talk about the finances of that new era. And the numbers are pretty clear, and I've shot a video on this before, but a Democratic president taking over for Republican tends to be the best future market. That has tended to have the best returns. And ironic and somewhat counterintuitive to most conservatives' line of thinking, which is lower taxes, lower regulations. Under Democratic rule, the market has tended to go up much more than under Republican rule. I'm not saying that's going to happen, but let's just turn to some charts right now. We're going to jump into our friends from White Charts. And since the election day of November 3rd, the markets are up 14.5%. So not only do they think that the market's going to be more stable, that they obviously like it, and that's the markets are voting with their dollars. And even since Inauguration Day, the markets have shown positive returns. Now, whether that is a more stable viewed government that they can, since Joe Biden has been in office or been in public service for over 47 years, they view that as more stability, which is something that Wall Street likes. I'm not going to speculate. All I'm just going to say is that the market has voted, and they voted in the past, and they tend to like this mixture. Okay, so let's kind of jump into, I'll jump into the other things about the S&P 500. So here's a 3-year chart of the S&P 500. And we've been moving steadily up. You can see this drawdown for the coronavirus, but we're well off of the February highs of 2020. I mean, we're well above that right now. But let's keep in mind, I'm going to look at the PE ratios of the 2020 highs. And here we are looking at the PE ratios. We're at a 34 PE. And to put that into some sort of perspective, I'm going to turn to our friends at Morgan Stanley, and I'm going to bring up this kind of chart here. Morgan Stanley has a chart that shows the S&P 500 forward PE ratio. This is where we were at December 31st of a 22 PE. This is where we were during the .com craze. So roughly at a 24 PE. And we all know what happened after .com craze. The market sold off for 3 straight years. I'm not going to suggest that's what's going to happen, but I will draw some parallels with this. So here we are at a higher number. And if we look at the next chart down, this is a regression that says, hey, if the PEs are roughly at 22, which is where we're at right now, in any given year, we could have a positive return, 20% up. So, hey, we're up 14%. The momentum's on our side. So maybe this year we'll also have another great year. But more likely, you can see more dots, you're going to have a negative year. Could be positive, more likely negative. Just because of the high PE ratios, not because of a Biden presidency, but because the market has run up already so much. Now, over a 5-year window, if we really look at the same data, this is 1-year returns, but if we look at 5-year annualized returns, that basically says you should anticipate no returns in the market for 5 years. Okay, that's a very dire kind of outlook, given where we're at and given what I just said. But that doesn't mean that you can't get a positive return. It just means overall stocks, given that they're already expensive, may not be doing so great. Now, here's the earnings estimates we have. So it looks like going through 2021, you're going to start seeing higher earnings as opposed to what we saw in 2020. And I'm going to shoot forward to this particular chart because this is going to talk to the next topic, where I said the average market should be kind of flat. But what we're looking at right now is value versus growth. We all know this is when value is cheap and growth is expensive. And here we are where growth is expensive and value is cheap. And it's been like that, again, back to the .com craze. We're starting to, we're about halfway there, but approaching some pretty high levels where value is very expensive. And then here's another indicator, PE ratios of the top 10 companies. So the PE ratios of these companies are getting way out of whack. The rest of the market is kind of in line with its 15 range, and maybe it's trading at 19, which is justifiable with these low interest rates, which we'll talk about next. But the higher level companies, the Apples, the Microsofts of the world, are trading at a higher PE, and normally they trade in line. In a healthy marketplace, they tend to trade in line with the rest of the market. But that's not what we're seeing right now. We're seeing them out of whack, okay? And I'm gonna show you one more thing. This is, again, the dispersion of the low end of PEs and high end of PEs. So let's take a look specifically at our company Apple here. So Apple, there's a 10-year chart of Apple that's been on a nice run and had a humongous run-up. And if I add the market cap onto Apple, you can see that it went from like a, let's just do this on the fly. Apple's market cap went from about, let's call it right here, over $1 trillion. It fell off under during the lockdown to 700 billion, but let's say it was $1 trillion. Now it's sitting at $2.3 trillion. So from about here, where it looks like it's at $1.1 trillion, to here where it's at $2.3 trillion, it doubled in size. But let's see if it, and this is over, let's see how its revenues were doing. Whoops, I misspelled revenue. So let's try that again. Revenue. There we go. So during this time, and I'm going to just put on a normalized percentage so you can see how Apple's revenues have grown over, let's say, just the past 3 years. It's grown 3%, so 1% a year. Is that justifying this PE ratio that's doubled? So let's look at, okay, so here we have that 3%. This just goes to the prior point. The PE ratio of Apple has tended to trade, I'm going to put an average on here, over the last 3 or 5 years, let's say 5 years, has tended to trade under 20, somewhere around 20, but it's at 40, 41. So it's more than doubled over that time. So that goes to that same chart that maybe the high-end companies are super expensive and you could be due for at least a consolidation. That means possibly the rest of the market might do well. So let's take a look at, here we have these PE ratios that are extremely high. The forward PE estimates are suggested to come down in 2022, but still coming down to a 25. And if you recall, a PE above 20 or in the 22s is still very high, so that's still pretty expensive. All right, so we're projected to have some nice earnings. This is the new line, the green line and the purple line. So the earnings per share of the S&P 500 took a dip. We're projected to come through in 2022 to have some nice earnings per share. But again, that's still probably not going to be enough in order for the market to really have amazing, amazing gains. All right, and I'm going to take some of these things off here real quick and compare this the S&P 500, which is an equally weighted index. I'm sorry, the S&P 500 is a market cap weighted index. It means the companies with the biggest market cap, like Apple, like Microsoft, like Google, like Facebook, they get the bigger weightings. Tesla. But if we look over time, so here we have, I'm going to show you a 1-year chart of, I'm putting up Invesco's S&P 500 equally weighted. And we'll put them on a percentage change. And you can see that the S&P 500 has outperformed over the last year, and in fact over the last 3 years, because the larger cap weightings have outperformed. But traditionally, over long periods of time, if we go out, let's say a maximum period of time, the equal cap weighted tends to outperform. Why? Because of the law of large numbers. Think about Apple trying to grow from a $2.3 trillion company. And even if it grows at 10%, it's got to add $223 billion onto its market cap. That number is bigger than 97% of all companies that have ever been in existence in the world. And it has to do that every 12 months. And it's only growing at 3%. So where's that growth going to come from? And if Apple can do it, Facebook has to do it, Google has to do it, Microsoft has to do it. Can they all grow from these high level numbers? If you're looking at Here we have the S&P 500, and I showed you, let's say this is Apple. I think the same story is true for Microsoft. Microsoft's PE also ran up. So you're going to see these same kind of situations. Now, more recently, you can tell the equally weighted S&P 500 outpaces in general, but over the last 1 and 3 years, the market cap weighted index has won the race because we've had this PE expansion from the big companies. But what we've seen is perhaps a changing of the guard. So let's look at the last 6 months or even 3 months where you're seeing the equally weighted S&P 500 index outperformed significantly. It's up by 5% there, and over a 6-month window, it's up by 7%. So you could see a changing of the guards where you're going back to the lower, more valued companies should tend to outperform. So if we're going to have a long-term returns of 0, but the expensive companies maybe aren't going to give you those same kind of returns, maybe we need to return to some sort of value base. And I'm going to go back to our friends at JP Morgan and show you this kind of graphic down here. We're going to hone in on this here. We're going to look at the current PEs versus a 20-year average. Current PEs as a percentage of the 20-year average. And as you can see, the growth is extremely expensive. Small cap growth, twice its long-term average. Large cap, more than 1.5 times. Mid cap, twice. But when we're looking at the value, at least the value is in some sort of range, and the small cap value is looking pretty attractive relative to the rest of the universe, investable universe. So if we're going to have to bet on what is going to do well in the future over the next 3 and 5 years, my money would be more on the value side and perhaps more on the small cap side. Okay, so that's something to think about. Now, I said I was going to talk about interest rates, and here we are at interest rates. I have the chart of the Fed funds rate where we have basically at 0, and the 2-year Treasury is kind of mimicking that Fed funds rate, not very much higher off of that 0 rate. And the 10-year, this is the most interesting to me. So the 10-year came down here with about 52 basis points, it looks like, and then started to trend up. And we're at over, or it looks like 111, I'm sorry, that's the, that's the original. So we're at 111 basis points. So that's more than doubled in the last, let's say, 6 months. So as interest rates start to expand, you could get PE compression. Right now, with very, very low interest rates, and the Fed said they're going to keep this really low, so the 2-year is going to stay low, but that doesn't mean the 10-year has to stay low. So if the 10-year starts growing, then what you're going to see is that discounted cash flow mechanism that values the forward earnings of companies is going to start compressing those earnings and the value of those earnings. So that will give you PE compression, which will play into that whole story of these growthy companies may not be able to grow and probably won't be able to grow. Like, think about this. If Apple's PE tends to be at 20 and it's gone to a 40 on 3% growth, do you really think it's going to go to 80? And if you don't think it's going to go to 80, then maybe any additional capital you're going to put to work in the market should go somewhere else besides, let's say, Apple stock. All right. So here we've looked at the 2 and the 10-year. Here's the 10 and 2-year spread, which is also moving up, which shows a sign of a healthy economy. And just as a kind of a reminder, when the 2 10-year spread goes negative, that tends to be recessionary. So let me, I'm going to go back 10 years here, and I'm going to see if I can put on, show US recessions. Let's do a max chart. And let's clean this up. So I'll take off the 2 and the 10-year, and we'll just have the 2 and 10-year spread right there. As you can see, as the 2 10-year spread turns negative, you tend to have a recession. Turns negative, tends to have a recession. Negative, recession. Just touched it. We had a recession. Okay? So as this is moving up, that's actually a really good economic indicator. So the market will be healthier over the long run, even though some pockets of the markets that have already run up probably aren't going to do as great. Okay? And then here's the inflation rate we have. Let's take off this, let's take off the recessions here. And here's the inflation rate. Inflation's starting to come up. What causes inflation? Actually, the biggest predictor of inflation is expected inflation. So as we start to see inflation move, we may start seeing a little bit more expected inflation. Okay, and another indicator that we'd like to look at here is your 30-year mortgage. So if you haven't refinanced your mortgage, you probably should step in right now, because it looks like we're getting a tick up of inflation, a tick up of the 10-year, and a tick up of the 30-year mortgage. So now would be an excellent time to refinance your house, because we're still under 3% and at historic lows. So going out 10 years, this is where we're at on our 30-year mortgage. Let's again clean that chart up so you can see how low we are. So if you haven't refinanced your house, go ahead and do that now. And since we're talking about the economy, let's take a look at unemployment claims. And this particular chart is the initial unemployment claims. And again, if you recall, we had a number, almost 7 million unemployment initial claims during the lockdown. We printed 900,000 this week, which is above our 4-week average of around 850,000. And to keep things into perspective, I'm going to go back to 2007, back in our time machine, to show where we were during the financial crisis. And this is the lockdown from the coronavirus. This is the financial crisis. And so you can see that the worst week of the financial crisis was 660,000 initial claims. And we are still consistently above 900,000 or 850,000 initial claims. So that does not bode well for our economy long term. Our continued claims are still at 5 million, where when we had full employment, we were closer to 2 million, leaving 1.7 million continued claims. But we're still at 5 million, so 3x where we would be in a healthy economy. Taking a look at the unemployment rate, we're at 6.7%, but our U6, so that incorporates people that could work, that haven't dropped out of the workforce or that are underemployed, is at 11.7%. And when we were pretty fully employed, our U6 number was under 7, and here we're at almost 12. Okay, so again, our underlying economy is not very healthy, so we need to really be wary of where we're putting our money and how we're going about investing this. So speaking of kind of being wary of things, here is Bitcoin prices. I can't not talk about Bitcoin. So over the last, let's say, year, Bitcoin is up 300%. But over the last 3 years, it's only up 176%. And that's because if we go back 1 month from this chart to, let's say, December of 2017, this is where we peaked last time. And if I put on these other charts, Bitcoin, Cash, Litecoin, Ethereum, these peaks look remarkably similar. So the leaders have changed a little bit, but you've had a sell-off and a run-up. Okay, so I might anticipate another sell-off in Bitcoin, but I would couch that with saying Bitcoin is gaining a lot of mainstream adoption right now. And the Biden presidency should be a little bit more accommodative to Bitcoin as well. And so as you're getting these hedge funds that are using Bitcoin as part of their asset allocation, and you're even getting some CEOs, like a handful of them, that are talking about using Bitcoin as opposed to just using holding cash, because they either A, don't trust the government and they want something decentralized, or it's a way for them to make money, or it's a way for them to hedge against a weaker dollar, then that might be an option. So if some are doing that, or at least if some people continue to allocate a little bit more to Bitcoin, then I think long-term Bitcoin is a good way to go. Now, if you're going to look at which companies or which cryptos have done better over time, Ethereum has actually done best over the last year, and Bitcoin has done second best. So, but I would keep it to, well, there's dozens of these cryptos, but I would keep it to the cryptocurrencies that actually have some real utility. So Bitcoin has utility in the sense that you can exchange it for goods and services, and it has an adoption rate, and people are actually using it to store value for a purpose that are, let's say, I'll go with more conservative holders. So there's going to be a larger market. So if there's ever is a downturn in cryptocurrencies, I think the other currencies will kind of go away. Very similar to how we were during the .com craze, when there were a gazillion .coms out there losing a bunch of money that didn't really have any value. And when there was a real market correction, we were left with just the big companies that made sense, like the Amazons of the world, right? And so I think it'll be a very similar story with you'll be left with the Bitcoins and the Ethereums and possibly the Ripples of the world, and stick with the mainstreams until there's perhaps a changing of the guards, which may happen down the road, like we did see with the internet bubble. We had the main companies, like you had Amazon and eBay and some of these mainstream companies, and Google and Facebook didn't come along till later. But still, the only way for you to have preserved your value is to have been in those mainstream companies from the get-go and then shifted when there was a changing of the guards. Okay, so I think that about wraps it up for where we are. Our summary would be long-term, well, short-term, the momentum's on our side, so we stay invested in the market. Long-term, we need to be wary of where we're putting our money, because growth companies just can't keep growing indefinitely without any real earnings or top-line growth. Apple, as great as they are, can't just keep adding market cap indefinitely without growing its top line. Okay, so we need to be aware of that. You need to be aware of what the numbers are saying, where you need to put your money, and not just continue with the old horses that have done really, really well for the past few months, because the numbers are suggesting, and historic history is suggesting, that that will not continue indefinitely. Okay, so this is Stuart Cruz with Cruz Asset Management, trying to help you and all our clients live your life with the odds in your favor.